morning, everybody. Most of you know who I am, but for those who don't, I'm Brenda Hunter, and I work with all of them here at mydkna, and my office is in downtown Oxford. And see how awake you all are this morning to talk about taxes, such a fun topic. So the last couple years, as you all know, there's been a lot of legislation about everything, but a lot of it does affect our taxes. So we started out in 2021. We had the Build Back Better. Most of that was about infrastructure and that kind of stuff. But obviously, to pay for all that infrastructure, it comes down to taxes. Then in 2022, or early on in 2022, we had the Inflation Reduction Bill. And late in 2022, very late December, we had the Secure Act. So all those kind of things have come together to where we are right now. And now they're trying to figure out how to pay for all this stuff that's happened in the last 3 years. Yeah. So we had a lot of stimulus. We had a lot of unemployment. The federal did supplement the unemployment for all the states. We had those extra child tax credits. All that created a lot of stuff that's come down to taxes. So in 2022, this is the new tax brackets. They've been slowly inching up, very slowly, but we do still have from 10% up to 37%, and each year they slide a little bit more into the upper categories. But these are what they're going to be for 2022. Anybody who wants a copy of any of this, we do have a copy of the presentation. We also have a list of anything you'll need for 2022 taxes. So don't worry too much about this. We can get you a copy. But I know everybody likes to see where they fall in these brackets during the year based on their income. And this is taxable income, not total income. So this would be after your deductions and credit. These are the estate and trust rates. And the reason I show these to you is I constantly get questions about estates and trust. So a lot of people think it's simpler to have the estate or the trust pay the tax. People don't want to deal with the beneficiaries, their siblings, or their children, whatever. They think it's just easier if the trust pays the tax. But the reason we usually discourage that is because if you look at this, tax bracket up here, by the time you're at 13% taxable income, or $13,000 of taxable income, you're already in a 37%, you're already at 37% tax. Whereas single and married filing joint, you would have to be at $539,000 or $647,000 for either single or married filing joint. So as you can see, you're better off having the beneficiaries pay the tax than the trust. And what you can do as a trust or an estate is reimburse the individuals. So what you can do, and what I often do for people, is have the beneficiaries pay the tax, do your tax return with and without the K-1 from the trust, and then have the trust reimburse each person accordingly to how much that K-1 from the trust affected their personal tax rate. So that's usually the best way to do it, because it's almost always better to have the individuals pay the tax than the trust. It's just the trust always pays a higher rate. As you can also see, the exemption amounts are very small for trusts as well. The other thing to bring up is that gifting max is $16,000. It was $15,000 for a very long time. They raised it, I believe, in 21. It's $16,000 per person. You can gift $16,000 per person. So that would be if you're married, you and your spouse both can give $16,000, kids, grandkids, any member, actually anybody you want, without a tax to you or a deduction as well. It's not an expense. It just gets money out of your estate. The federal exemption is now $12.6 million. That means off your lifetime exemption. So if you do gift more than the $16,000, say you wanted to gift a house or something to one of your children, you would just file a gift tax return and let the government know that you did gift more than the $16,000, and it doesn't cost you anything as far as tax, but it would come off your lifetime exemption.
Just for edification for everybody, can you explain to them when they're gifting out $16,000, how does that affect that exemption?
So if, say the 16,000 doesn't affect at all. So you can give 16,000, you, your spouse, 16,000 to each kid, each grandkid, and you don't have to do anything. If you go over the 16,000, so say you gift a house, and the house is $100,000. Then it would be the difference between 100 and 16,000 would be deducted from this $12.6 million. So when you pass away, in the year you pass away, they would look at that $12.6 million, and that would be the amount. Anything over 12.6 would be a state tax would come in. So anything below that would come off your death exemption, basically. So they've already taken, if 3 years before your death you gifted that house, then they would say, okay, you get a 12.6 exemption, but 3 years ago you gifted this house, so you don't get a 12.6 exemption, you get less the amounts you gifted in this lifetime. So over the years, you may or may not file a gift tax return for anything you gifted over the exemption of $16,000 per year per person. So that's kind of how it works. So, and as you probably heard in the news, they've had a lot of discussion on that $12.6 million federal estate exemption. There was years where it was 1 million, years where it was 5 million. It's very high right now, but they keep talking about reducing it, and that's why there's a lot of people do gift the 16,000 per person to try to reduce their overall estate, is to try to reduce it in the event that the government reduces this very large estate exemption right now. And for a while, there was people making A and B trusts, so spouses would have separate estates just in case this happened again. But right now it is rather large. Last year it was about 11.7 million. It's up to 12.6 right now. We don't know what's going to happen. You know, our government talks a lot about different things, but in the event it does go back down, it's something you'd want to discuss with your estate attorney about what you can do to reduce that. Standard deductions, so again, the personal exemption is 0. They have a very large standard deduction, but no personal exemptions. So the single personal exemption is $12.950. If you're over 65, you get an extra $1,750. If you're married, it's $25.9, and each person gets a $1,400 exemption if they're over 65. So the larger standard deductions, and this is if you do not itemize. If you have more than those amounts, you can itemize, and that would be things like property tax, state tax withholding, charity, plates on your cars, those kind of things would be your itemized deductions. But a lot of people, especially if they've paid off their mortgage, they get to a point where it's hard to get over these dollar amounts. Capital gains. So these are the capital gain rates. They go from 0 to 20%, and it depends on where you fall with your income levels. Some people try to strategically get into the 0% by keeping their income low so they can get rid of some of their capital gains at a 0% rate. This is a great thing to do if if you have a year where your income's going to be low for the year. It might be time to cash out some stocks that or mutual funds that have some capital gains. And strategically stay in those low capital gain rates. Child tax credit. So while many of you probably don't have young children, this is something that has been a crazy thing in the last few years that was really confusing. But for years it was like a lower amount, and then all of a sudden in 2021 they increased it really high and gave everybody a pre-amount. So they raised it to $3,600 for kids up to the age 6, $3,000 for kids 7 to 16, and then $500 above that. But they also, in July, started giving people prepayments on this child tax credit, which was very confusing because I would say probably 50% of people didn't even realize they were getting it because they were just automatically depositing it in people's bank accounts. And shockingly, most people today don't even look in their bank accounts. So they would come in to get their taxes done, and I would say, so did you get the prepayments on the child tax credits? And they would say no. And I would say, are you sure? And they would say, I don't know. And so then we'd tell them to go look in their bank accounts, and they'd say, oh my God, I am getting $500 a month. It's like so it got really crazy last year because between stimulus payments and child tax payments, people didn't even know they were getting them. And sometimes it was frustrating because we'd try to get these numbers, we'd file tax returns, they'd get notices because they'd come up with the wrong amounts, they couldn't find them in their bank accounts. It was a lot of, and as you can imagine, the government's just kind of in a mess right now. You can try to call, you can't get through. I'm sure several of you may have tried to call on things yourself. You can't get through. I have a prepare line. I still couldn't get through on that. So what's happened with preparers is a lot of CPAs, because we couldn't get through, they have enacted this thing. It's called like a service, where the service tries to call. And so many people have done this that we couldn't get through at all. So what the government has done now is they've made so that if you try to call, you have to answer questions, try to get the robocallers out of there. So I have to answer basic questions like simple math, like what's 5 + 9, repeat back words. It's kind of funny, but at least it gets rid of these people who have services trying to get through. But that's my practitioner line. I don't know how regular people get through because you just can't. There's so many.
Do it on purpose.
Yeah, it's kind of crazy. But so in 2022, it goes back to $2,000 per child up to 16. No variation for under 6 or under 5 or under 6. $500 for age 17 or other dependents if you take a parent or any other dependent that you may be responsible for. The credit is partially refundable, meaning if you wipe out your tax with other things, you still get $1,500 per qualifying child. But you must have earned income. This is the first year they've done this ever. Prior to this, you could still get the child tax credit even if you didn't have earned income. And now you have to have at least $2,500 of earned income to get the child tax credit. And in 2022, there is no monthly advance. Thank goodness. Some other miscellaneous changes for 2022. A lot of people will be very sad to learn that there is no above-the-line charity deduction this year. And that hung on until December. That's one of the things that they got rid of in the Secure Act in December. We kept waiting to hear on that. They did finally get rid of that, which is kind of surprising. That's that thing that...
Was that the $300?
Yes. That was singles could take $300. Marrieds could take $600. So even if you did not itemize, you still could take a small amount of charity above the line or separate from your itemized deductions. And the reason they did that in the first place is because charities were complaining that people weren't being as giving because they could no longer take charity on their tax return because of the large standard deductions. Now, truthfully, people should give from their hearts and not because they get a deduction, but we all know that some people just do it to get the deduction. So for a while, they were letting people take small amounts on top of the standard deduction, but I'm not sure why, but they got rid of that for 2022. HSA amounts, you have to be under 65 to put into HSAs, but you can still continue to use them as long as you have money in the accounts. A lot of people who were working just kept maxing them out, which was a great idea, so that you've got that money to pay for whatever your health insurance or your Medicare does not cover. But the contribution amounts in 2022 are $3,650 and $7,300. If you're over 55, you can put an extra $1,000 in. Student loan interest deduction is $2,500. If you're, I know that the student loan, the federal loans are still on deferment again, but a lot of the non-federal loans, people are still paying on them, so they do still have interest. Mileage rates, due to the really expensive gas right now, in July they went up. So if you have business mileage, it was 58.5 cents the first half of the year, 62.5 cents the second half of the year. Charity, 14 cents a mile, and medical, 22 cents a mile. One other small change that I didn't list up here, if anybody is a teacher or knows a teacher, they did actually, after many, many years, increase the teacher credit. So the teacher credit is something on the front page of the 1040 that allowed teachers to take an above line credit for it was been $250 forever. That went up to $300. You know, I know teachers spend a lot of their own money out of pocket to buy supplies for the classroom, whatever. I'm sure it's significant. I know it's significantly more than that, but they did finally increase that to $300 that they can take as a credit. So these are some of the things that were in the Inflation Reduction Act. I really question the name of this because I'm not sure how it helps inflation, but that was the name of it. I think they named it that to make people think that they were doing something great for inflation, but I don't know how any of these actually affect inflation. But so these are some of the things that passed early in 2022. So the first one was the corporate alternative minimum tax. So for years, individuals have had an alternative minimum tax. Years ago, it was kind of a pain because what would happen was people would have credits or deductions, but by the time they got to their tax, the alternative minimum tax would kick in and they would have tax because of this alternative minimum tax. We don't see it as much anymore unless it's somebody with really high income and a lot of deductions. But now, corporations have this as well. Now, this would really only affect C Corps because S Corps are a pass-through entity. So C Corps, 1 billion and above, so they can't have any. They have a corporate minimum income tax. So while the regular rate is 21%, they can't use losses and stuff to bring themselves down any lower than 15%. The other thing is the research credit. So they've now they're trying to encourage small businesses to do research, research and development for new products. So they are, increasing the credit for them, and they're allowing them to take it as a payroll credit as well. So these are two things that also came out of the Inflation Reduction Act. The first one is to help fund the health care, which is done through the marketplace. So that was running out of funding. So those are the subsidies for the people on the marketplace health insurance. The funding was running out for that to pay the subsidies on that, and now it's funded through 2025. There's also a calculation on there where they have to fill out what their income is. It's reconciled on their tax return, so they can't just say what they want to say you'd be shocked at how many people have to pay it back on their tax return and they don't realize that they can't just pick any old number. It has to be reconciled on their tax return. So those are the only people now that have to still bring in proof of health insurance, are the people that are on the marketplace. But that is now funded for a few more years. But the bottom one, and I'm not sure how many of you have heard about this, but there was a lot in the inflation bill that really does help people on Medicare, and that's with this prescription thing. So I'm sure many of you have struggled with prescriptions. I know I did with not only myself, but also with my parents. Sometimes you go to fill a prescription, and it's like, really? They're ridiculously expensive. And there's no rhyme or reason. I'll get one and it's $8, and I'll get another one and it's $150. And there really is no rhyme or reason to what it is or why it's that much. So the government is now trying to force prescription or medical companies that they have to negotiate with Medicare on the pricing on prescriptions. And this is kind of a graduated thing, and it's going to happen all the way up through 2029. But every year, so many drugs have to negotiate their prices. And starting in 2024, the max a Medicare recipient can pay out of pocket for medication is $2,000. I'm sure everybody's heard this part of it because this has been broadcast over and over, is that the IRS is hiring 87,000 agents. Now I believe they're trying to fight this. I'm hoping they'll at least hire a few hundred and put them in the service department, but I will say that by the end of 2022, they have hired some. Unfortunately, they're not training them very well. So sometimes they answer the phone and I feel like they're just looking up in a publication and they don't really know what they're talking about, but it is getting a little easier to get through the phone lines. So we'll see. Their goal is supposed to be to help fund all these things they have been passing and spending money on, and who knows what the outcome of this will be. But the goal is to find lost taxes to help pay for all the money they're spending and raise the debt ceiling. I'm not sure what they're going to do about all that. All right, so on to other things that were passed in the Inflation Reduction Bill. So one of the big things that was passed in the Inflation Reduction Bill was energy efficient home improvement credits. So in the past, these kind of had a misleading name. They were called residential energy, but now it's actually being called energy efficient home improvement credits, which is a little more what it should be called. In 2022, they're pretty much the same as they've been in the past. The limit is $500, and it's the same thing. The furnaces, the things that they've been in the past. But starting in 2023, they're going to go up significantly. So you're going to get to write off 30% of the cost of all these items with limits on all these items. So it's going to be a $1,200 annual limit instead of $500 lifetime limit. And you're going to be able to take all these things. You can do a home energy audit. Now, people have said that I guess you can get a free one through DTE, but there are places that charge for them. So if you get charged, you can write it off on your taxes. 30% of the cost up to $150. $250 for one door, 30% of the cost up to $500 max. Windows, same thing. And then obviously insulation materials, 30% of the cost. Furnaces, air conditioners, water heaters. And then you get into the bigger things like the biomass and the alternative type fuels. And those are 30% of the cost up to $2,000. So roofing is no longer included in this anymore. Years ago there was a roofing credit, but the problem was it was actually metal roofs. It wasn't just any roof, and that got really confusing, and now they've taken roofing out of it altogether. So this will start in 2023, which is this year, so if you need to do anything, now's the year to do it. But actually these are going for a couple of years. So the other big thing in this, which was very confusing, but is the electric car credits. So the electric car credits started in 22 and they're going to go on till 2029. 2022 was somewhat simplistic, other than it was a $7,500 credit. Up until August, it had to meet some requirements. But it had to be the first 200,000 cars sold by that manufacturer per vehicle, which a lot of them sold out very quickly, pretty much all the Teslas and all the cars that you probably know of. But it had to meet these requirements: external charging source, the gross weight of the vehicle. In the beginning of when Build Back Better first had this in it, and then it moved into the Inflation Reduction Act, electric bikes were in that. They ended up getting taken out, but a lot of people didn't realize that. So a lot of people were coming to me saying, oh, I bought an e-bike. Well, e-bikes got taken out between the two bills. So a lot of people were disappointed about this. It ended up being only cars. By the time we moved to the end of 2022, from August to December, they added the fact that the cars had to be assembled in Northern America. So obviously not Mexico, which is still a lot of our car companies, but I'm not sure why they added that. 2023.
Question: Mexico is part of North America.
Oh, is it? Okay. Well, then I'm not sure where they think they're being assembled, but they added this requirement. Okay. In 2023, it gets really complicated. So in 2023, they start adding a lot of requirements about battery materials. And so first of all, it adds the credits of so you have a $7,500 credit for new vehicles, $4,000 for used, although they still have to be bought at a dealership, $40,000 if they're over 14,000 pounds, and now they've added income limits. So if you make over a certain dollar amount, whether it's the new vehicles or the used vehicles, now you have an income limit. Then they add a dollar value on the vehicles. So the trucks, sport utilities, and pickup trucks have to be at least $80,000 or cannot exceed $80,000. Then the vehicles can't exceed $50,000. And then there's a bunch of other, I know, well that's the issue, is a lot of the electric vehicles are automatically taken out because of that restriction right there. There's a lot of other restrictions as far as the battery type, where they're assembled, how they're assembled. It's about 5 pages long, all the restrictions. So if anybody is thinking of buying an electric car and wants to know if it meets that restriction,
I'll run the rusty, I'll drive the rusty one.
let me know and I'll get those to you. You have to like run through all those requirements. It is kind of long, but the Chevy Bolt does meet those requirements. There's a few of the other ones that do. So let me know if you're considering it and I'll let you know. And then there's also different rules about buying it and taking ownership of it, because sometimes there's months in between those 2 dates. There's a lot of restrictions and I didn't want to bore you all with all those details. Like I said, if anybody's considering it, let me know and I'll run it through for you. Virtual currency, also known as cryptocurrency, it has a lot of other titles. The only reason I bring this up is because this is another thing that the IRS is looking to try to pay for some of their money that they're spending. This has become really big, a lot more in the younger crowd. A lot of people don't touch it now or don't want to touch it. It actually took a big dive in 2022, but some people still believe in it. But the question is, the IRS is trying to get people to come out of the woodwork with virtual currency because a lot of it is still not reported. Although we have seen a lot of it come out with, Infidelity, Robinhood, and Coinbase are reporting now. And in 2023, they're making more requirements of a few other agencies that have to report. But now they're coming forward and saying these are what they consider taxable income and non-taxable income. For those of you who don't deal in virtual currency, the problem with it is you can have a virtual wallet and you can spend it, gift it, transfer it, and bless you. So it gets confusing what is income and what is not. So they've come forward and say these are the things that are taxable income, these are the things that are non-taxable income. So compensation, mining income, rewards, airdrops, similar to kind of maybe a credit card. So these are, younger generation are kind of having this wallet of different types of virtual currency and spending them on video games or things in the web. So this is kind of it's very confusing, but the IRS is coming forward and saying this is considered taxable income, this is not. So they're being very specific of what to consider is and isn't. Trust me, I've been seeing a lot of it in the last couple of years, and so it's even confusing for us to try to figure out. Because what happens is sometimes with these people who deal with virtual currency is they move it from place to place, so they don't always have a good cost basis because it gets moved around a lot. But we are seeing a lot more of it. Student loan forgiveness. So this is been another hot topic in the last couple of years. They were fighting hard to do a big loan forgiveness. The details were that if you had a Pell Grant, you were to get $20,000 in loan forgiveness. If you did not have a Pell Grant, and Pell Grants would be if your income was below a certain amount, you qualified for a Pell Grant. If your income was not below that certain amount, you just got regular student loans. So that's how you qualified for this forgiveness. If you got the Pell Grant, it was $20,000. If you didn't qualify for a Pell Grant, you got $10,000. At the time it first was talked about, it was based on your 20 or 21 taxes. It's dragged on. Now it could potentially be, on your 22. And then these are the loans that were eligible for forgiveness. Basically anything that went through the federal loan system. So, these were the undergraduate subsidized loans, Parent Plus, grad loans. So even the Parent Plus loans qualified for this, Perkins loans, and even loans that were in default or are in default. As you, I'm sure, know that this is, and then the forgiven amount is not considered taxable income as long as it meets all these requirements. However, this is still sitting in Supreme Court. It's anyone's guess. My guess would be probably it's not going to pass, but retirement. So this is another thing that has been really confusing in the last few years because they keep moving around the years that you have to take RMDs. And RMDs, while they don't affect Roth, people that have Roth accounts, unless it's an inherited Roth, they do affect IRAs, 401ks, 403bs, SEPs, and simple plans. Well, this is actually putting in money for IRAs. So if you're making a contribution, you do have to have earned income. We get that call a lot. People are trying to reduce their income. Can I put in an IRA? No, not if you don't have earned income. And you must put it in by April 18th this year, which is tax day. And then there's phase-out limits on your putting in an IRA or putting in a Roth. Backdoor Roths are still available. You can still do that in 20 and 23, as are Roth conversions. So these are the rules that I was talking about, are they keep moving the ages. They keep moving the ages for RMDs, presumably because people are living longer and don't want to take money out of their accounts. But they've moved it twice in the last few years, and they're moving it again in 10 years. Why they're even doing that, I'm not sure, because they'll probably move it again. But so this is how it works. If you turned 72 and 22, you have to take that RMD. If you didn't turn, you can wait till 23 at age 73. So that was what was kind of confusing, because people were hearing those two different ages. But if you already turned 72 and 22, that was your year. But if you didn't and turned it, you could wait till 23. Now this is the other really confusing thing about this, is technically the year you turn the age of RMD, you have till April of the following year, theoretically, to take your first RMD payment. So if you don't take one your first year, you can wait till April, but now in year 2, you have to take 2. So that's where people get really confused. You might as well, if you don't want to increase your income, you might as well take it in your first year that you turn 72 or 73, depending if it's year 22 or 23. So it gets a little bit confusing. Qualified charity distributions from IRAs are allowed up to $100,000. This is a great way to reduce your income if you want to give to charity and can't take that charity deduction because you're taking a standard deduction. Do it through your RMD on your through your IRA, and then you get full deduction for it, not only on the federal but also on the state. So it's a great way to get the benefit of it and give to charity. You can do it up to $100,000. I'm sure a lot of people have talked about this, but they eliminated the stretch IRA for non-spouse beneficiaries. And what this means, if you are not the spouse, you have to get all the money out of that IRA within 10 years. But if the person who was deceased was already taking RMDs, you still have to continue taking those RMDs. That got really confusing in 20 and 21. A lot of people thought, well, I have to clear it out in 10 years, but I don't have to take the RMDs. Yes, you do. The penalty for missing your IRA or your RMD is 50%. So if you miss taking an RMD, the penalty is 50%. However, we get these calls all the time for somebody who accidentally forgot or whatever. We tell people as soon as you realize the mistake, take your RMD. We are always there to write a letter or to help people, but honestly, I've never seen anybody actually get penalized on this. The IRS is in too much of a mess right now to worry about that kind of thing. And usually it's an honest it's usually an honest mistake. I've never really seen anybody blatantly not take their IRMD because they didn't want to. It's usually an honest mistake. So we always tell people as soon as you realize your mistake, take it and move forward. And Social Security. So Social Security, everybody got a raise this year. Congratulations. And then a lot of people, these are the questions we get all the time from Social Security. If you're not full retirement age, you can still work, but you can't make, every year they raise this amount, but you can't make more than $21,240, or they will start making you pay back some of your benefits. For every $2 you go over that, you have to pay $1 back. Full retirement age for everybody is 67, or if you're between 65 and 67, if you were born between years 1937 and 1960, it's prorated every 2 months. After full retirement age, you can earn as much as you want, and that just means you can earn as much as you want without paying it back. It does not mean it's not taxable. There's a difference between earn as much as you want and not pay it back and not being taxable. That's the second most question we get, is people are very confused when they start getting Social Security. Many of them say, I don't understand, I thought it wasn't taxable. It is not taxable in the state of Michigan, and if your income is very low, it may not be taxable. But it depends on your other income, and it's a formula. So at the bottom here, I do have some basics for people. If you're single and your other income besides Social Security is between 25 and 34%, or $34,000, your Social Security will be about 50% taxable. And then if your income is more than $34,000, it'll be about 85% taxable. 85 is the maximum your Social Security can be taxable for federal purposes. For married filing joint, it's $32,000 to $44,000. It's about 50% taxable. And then over $44,000, it's about 85% taxable. So that just gives you an idea where you fall for tax purposes for Social Security. And you can have taxes taken out of your Social Security. We usually suggest people do that if they have a decent amount of other income. And we can help people do that if they're not sure how to do that. We have forms, or you can usually go on the website and have it done. One of the things that we have, for a lot of people, if it's not convenient for you to come to our office, we allow people to drop off their documents. But if it's not convenient for you to get in to see me, we do have an e-file cabinet system where we can send you a secure link that you can upload all your documents, and we have a few really nice ladies that will walk you through how to do that. But your data is completely secure, so you can just scan it and upload it into a secure format. And that will also help you electronically sign your 8879, which would help us e-file your return. But we can walk, there's a couple, like I said, ladies at my office that will help you do that, and it just makes sure everything gets done. If you are not local in town, a lot of people go south or go somewhere else, but that would help you get your taxes filed if you want them done on time. We can also file an extension for you if you're not going to be around in April. Return dates, taxes are due April 18th this year. I think the 15th falls on a weekend, and Monday is Emancipation Day. So again, I don't think we filed on the 15th for several years, but so I think that's a Tuesday. We have a lot of people who actually don't want a paper copy of their return anymore. They've gone, I think Dan's office, they have a vault system where you can keep all your documents. So a lot of people they're tired of keeping paper. So we can get you a PDF only copy if that's what you want. We can also scan all your documents for you and give you a scanned copy of all your documents too. If you just let us know up front, we can get that for you. And then we must have two things, for your tax return. The first is an engagement letter. We usually have you sign that up front. And an 8879, which is that, you're okay with us filing your tax return. We do like you to look at it first, and then tell us that it's okay to file that. So those are two things. And again, we can do those electronically for you. And that's it. Does anybody have any questions or?